Investing 101. What is market cap? Stock price times number of shares of the company equals to market cap. For example, a company has $20 stock price and 10 million shares total, then we reach $200 million market cap. Is it cheap or expensive? When we want to know the value of the company, in other words, market cap, you can go to a popular website like Yahoo Finance. If you type Tesla, then you get a $620 billion market cap. To understand better, let's categorize companies according to their values. If a company has more than $10 billion value, we call them large market cap, large cap companies. Between 2 billion and 10 billion, they are mid caps. Small cap companies have between 300 million and $2 billion company value. If you go below 200 million to 50 million, then we have micro cap companies. Companies with larger market caps become less volatile because volume and number of transactions increase. However, when we go towards micro cap companies, they become risky and volatile and open to manipulations. So Tesla is a large cap company then. Do you think are they bigger companies than Tesla? Let's check the 5 biggest companies by market cap in US together. Apple has $2.5 trillion. Microsoft is right behind with 2.2 trillion. Then we have Amazon with $1.9 trillion claiming the throne. Google falls behind Amazon already with 1.8 trillion. Then there's Facebook chasing them within a distance with $1.1 trillion. Apple is the king at the moment. To understand better, let's compare Apple with other smartphone makers. After Apple, Samsung comes with 500 billion, then we have Xiaomi with 85 billion. When you want to buy the stock, first compare with their competitors. In this case, you can ask, can Xiaomi become next Samsung or Apple? Just looking here, we cannot decide on that. We need to know their sales and profits as well. How should we compare market caps? Looking at their profits, sales, industry, and future growth, we can make use of market cap better. Let's take net profits. What is price to earnings ratio? In other words, PE ratio is equal to company's value divided by total profit of the year, or market cap divided by net earnings in a year. Why do we use this ratio? Let me explain you with a real estate example. It's like a buy decision for real estate. You will buy this house and rent as an investment. What would you do? Purchase value is $500,000 and annual rent is $20,000. To understand whether this house is cheap or expensive, you divide purchase value with annual rent to calculate in how many years you will get your investment back. 25 years. In other words, PE ratio. In this calculation, if you use last year's earnings, we call it trailing PE ratio. If you say company will grow, so let me take next year's earnings, then you get forward PE ratio. Which company would you buy? We have two companies, company A and B. They are in the same industry and have similar growth. Company A has market cap of $10 billion, whereas company B $30 billion. Their next year's earnings will be 200 million and 5 billion accordingly. Which one is cheap? If you look at their forward PE ratios, dividing 10 billion to 200 million, we get 50 for company A. And similarly, 20 forward PE for company B. Then we say company B is way cheaper. Let's continue with a real-life example in semiconductors industry. Here I prepared a table where I listed 7 semiconductor makers: Micron, Intel, Nvidia, Texas Instruments, and so on. In the first 3 lines you see their stock price and market caps. Below, I listed their past and estimated earnings together. In a quick look, it is better to look for companies below 25 PE ratio, which is an average value for the stock market. We narrow down to 2 stocks, Micron Technology and Intel. Growing companies tend to have bigger PE ratios, so it is safer to go with Micron technology. That's why I already made a video about it. You can ask, what if there is no profit? Then we look at their sales. What is price to sales ratio? Similar to PE ratio, price to sales ratio is equal to company's value divided by total revenue of the year, or market cap divided by net sales in a year. Let's continue with a real-life example in a vegan food industry. Here I prepared a table where I listed 3 vegan food companies: Very Good Food, Tattooed Chef, and Beyond Meat. These companies don't have any profits at the moment. They promise huge growth that they will become profitable in the future. In these first 3 lines, you see their stock price and market caps. Below, I listed their past and estimated earnings together. In a quick look, it is better to look for companies with low price to sales ratio, below the industry average. In this case, for 2021, Tattooed Chef looks better with a 7 price to sales ratio. When we check the next few years, looks like it is expected that Very Good Food will grow big and bring high revenues compared to its market cap. For in-depth analysis about these stocks, you can check our vegan food stock playlist. To add price to sales ratio more value, we can actually take debt and cash into account so that we have better understanding in valuation of companies. Enterprise value to sales ratio is one of the popular ratios people look at. We add debt and subtract cash from market cap. Dividing by net sales, we get enterprise value to sales ratio. In this logic, the more cash company has, the ratio becomes smaller and reasonable. When we have high debt, this should be compensated by high revenue, and it makes sense. Let's calculate EV to sales ratio of Beyond Meat. So this is the balance sheet of Beyond Meat from Yahoo Finance. We already know the formula and we have all the data. Let's calculate together. $7.86 billion market cap plus $1.14 billion debt minus $1 billion cash divided by $0.57 billion, then we get 14.1 enterprise value to sales ratio. When we compare this value to other vegan food companies, Tattooed Chef looks way more better with 6.4 and Very Good Food EV to sales ratio is 12.1. You can ask, where can I get tables like this to check PE and price to sales ratio calculated automatically for me? The answer is the stock analysis cheat sheet. Here our purpose is to compare the stocks in the same industry. Looking at this table, we look for profitability, price to sales ratio and growth expected in the next few years. For example, looking at our vaccine stocks, BioNTech, Moderna and Novavax are top 3 with their efficacies. You can click also here to reach update videos from our channel. In addition to PE ratios, here below you can see the price to sales ratios of the companies so that you can have more insights. To give you the feeling of the stock analysis cheat sheet, I want to show you other industries quickly as well. Let's check the semiconductor stocks. Here you see, for example, 7 semiconductor makers from USA. So after semiconductor stocks, we have automotive stocks. In our YouTube channel, we have automotive stock analysis videos. We made in-depth analysis for Tesla and NIO. In addition to that, we compared German makers BMW, Daimler and Volkswagen. And finally, we have e-commerce stocks where we compare Amazon, Etsy, Alibaba and Square. If you support us from Patreon, we can add here your suggested stocks and industries so that we all benefit together. So here's our Patreon page where we have 2 levels of membership. Stock analysis cheat sheet will be available also separately. Providing this tool, we ask for your support so that we can grow this channel faster. We have 2 levels in our Patreon page with early bird discounts. Stock analysis cheat sheet without portfolio access is €1.49 per month. If you want the whole portfolio access, including stock analysis cheat sheet, it will be €299 per month. You can give it a try and cancel anytime. While asking your support, we want to provide value in return.